All right. Hi, guys. Just wanted to thank you for coming by, spending some time to register and come by for this presentation. So this is our first webinar from TokenAnalyst, and the title of it is Intelligent Investing Using Blockchain Data. My name is Sid Shekhar. I'm the co-founder of TokenAnalyst, and you know, some of you may know about us, but others may not. But our kind of inspiration for doing this webinar was a lot of people keep asking us, what are we actually looking at when we look at on-chain data, and specifically, how is that relevant to the markets, to the crypto markets? The majority of the crypto universe today is focused on trading and speculation and trying to make money off of digital assets, and a large portion of the attention is on price. And for us, the focus was from the get-go was looking at the blockchain itself and looking at what's happening on the blockchain. And we've been going for about 2 years now, and we've seen a lot of things in our years of operating and diving deep into blockchains that we just thought were interesting to share, especially as it comes to the crypto markets as a whole. And so that's why we really wanted to do this webinar, to share some of the findings that we've seen. And yeah, so diving right in, is just kind of the agenda of the webinar is a bit of an intro about us, what we do, what we're up to, and then a look into longer term kind of fundamental metrics that we see most used for medium to longer term traders and investors, and then kind of the shorter term flow metrics, which are essentially a lot of the stuff that you guys probably have seen on our website or on our Twitter channel, which are more oriented towards quantitative or algorithmically driven trading. And then finally, we'll top it off with a couple of easy ways to integrate on-chain data into your existing workflow, and how best to go about doing that. So a bit about TokenAnalyst. As I was saying, we started about 2 years ago, and everyone around us was looking at the price and looking at how the price was moving up so rapidly. And for us, the kind of insight was that no one, in fact, was looking deeply into what was happening on the blockchain itself. And so over the years, we've seen a lot of new blockchains and protocols come into this space, not just from the Ethereum side of things, not just the projects built on top of Ethereum, but new chains altogether. And these involve, different types of validation mechanisms, consensus mechanisms, different instruments on top of chains, such as DEXs and dApps, and then different ways to utilize blockchains, such as staking and lending and the whole DeFi ecosystem. And so to understand all of this data, essentially, that's stored on the ledger was a huge challenge, and it remains a huge challenge. First off, you need a pretty expensive and hard to run technical infrastructure to get this data at scale. So we're running several Bitcoin and Ethereum nodes today in production all over the world, and we get this data, and essentially, how it comes out as is raw blockchain data. So on the right here, that's what you see. It's raw blockchain byte data is how it comes out, and there's very little transparency into what's actually going on the blockchain, and who's actually using which token or project and for what purpose. And so that's kind of what we do on a day-to-day basis. We try to make blockchains easy to access and understand. So essentially turning this raw blockchain byte data into interpreted human-readable semantic transaction data. So for example, you can see that a whale deposited a large amount of Bitcoin into Bitfinex on a given day, or a human being or a human-like wallet was interacting with Compound. And so our key focus has been around who is transacting on chain, but broader than that, it's just generally adding more and more context to what's actually happening on this on-chain layer. And when it comes to the markets, it's important to distinguish between on-chain versus off-chain data. So what we see as on-chain is effectively everything that's on the ledger, on the distributed ledger. This is blocks, transactions, inputs, outputs, smart contract calls, fees, token supplies, wallet balances, everything that's stored on the blockchain distributed database. And the off-chain data side of things is essentially everything that happens on the databases of centralized exchanges like BitMEX, Binance, the prices, the order books, the exchange volumes, sentiment data that's gathered from various channels from the web, trade data, everything that happens that influences the market that's outside of the ledger itself is what we regard as off-chain data. And the majority of the market today is focused on off-chain data. It's focused on prices, on volumes, and on order books. And there's actually very few players who are looking deeply at what's happening on the ledger. And our belief is that this is actually one of the key components that differentiates this industry from traditional equities markets, because it offers a lot more transparency into what's actually going on in this market. And so that's why we really wanted to take a deeper look at this in regards to the markets and see how on-chain data can help us navigate the crypto markets more intelligently as traders and investors. So within on-chain data itself, we kind of see it from two different lenses. So there's A is the kind of longer-term fundamental metrics or stats, and then there's the shorter-term kind of quantitative or flow metrics. So some of the longer-term fundamentals include, on-chain volumes, UTXO metric, token supplies, various smart contract metrics, and these are kind of more what you would see in a traditional equities kind of 10K report or fundamental network health of an asset. So this is kind of judging the longer term trend of how a given asset or an ecosystem is doing, and looking at some of these metrics sheds light on what's actually happening on the ground on the blockchain in regards to that asset. Meanwhile, the flow metrics, or the shorter term ones, are more for quantitative or algorithmic traders who want to execute really fast and react to events that happen on the blockchain. If you really think about it, the blockchain is essentially just a massive event database, and new events are popping up all the time as new transactions are made, new smart contracts are created and invoked, and different actors interact with each other. And so when we're adding context to blockchain data, combining speed along with context is a very deadly combination in terms of actually capitalizing on novel events that happen on chain before they actually land up on, for example, the wallets of exchanges, where eventually they move the markets and the prices of these assets. So first off, we'll be taking a look at some of the longer term fundamental metrics that we've seen. First, of course, comes the on-chain volume. So for Bitcoin and for Ethereum, it's important to distinguish between real and change. So for Bitcoin, it's there's for example, price dipped yesterday pretty significantly, and if a normal person was looking at Bitcoin on-chain volume, they would see a pretty large number, but the actual real economic value of Bitcoin that was transacted was around 73.97K during shortly after the dip that was transacted on chain. Whereas if you look at the change volume, it's actually way more than that. But what it really signifies is essentially Bitcoin that's moving on chain, but it's moving back to the same entity that sent it. So essentially, it's non-economic movement of funds that has no meaning except for showing volume on chain. So a lot of people look at on-chain volumes as a kind of metric for the network health of some of these large assets, and it's important to distinguish that it's actually a kind of a nuanced metric where you have to really consider what's the real economic value that's being transacted and who is actually transacting when you're looking at volumes. A similar scenario exists for Ether. On Ethereum, there's something called external, or what you see on the ledger, the normal ETH transaction volume, and then there's also the internal Ether volume. So internal transactions are something that not a lot of people are aware of, but it's essentially whenever smart contracts initiate value transfers of ETH. So essentially, this is an example of this where I, as a human being, may have sent some ETH to a smart contract, but this smart contract then triggers several ETH transactions on its own due to internal function calls that then transfer ETH to multiple parties, several other smart contracts and other human beings as well. And these are what we call internal transactions. And the value transfer that's happening on internal transactions is huge. Several billion were moved over this past year alone just through internal transactions. And a lot of these transactions don't manifest themselves on the surface of the blockchain. You really have to dig deep into smart contract calls to see how the ETH is actually moving. So there is a distinction to be made, between the economic value that's actually being transacted on chain and then the non-economic value, the change and the kind of value that's not actually moving between different parties. Another different kind of trend or longer term metric to look at is essentially for Bitcoin, especially, is the behavior of UTXOs. So UTXOs are unspent transaction outputs, where you have UTXOs that have not been spent for several years. For example, this is a chart over time from the beginning of Bitcoin. Putting UTXOs in age bands in terms of when they were last spent. And you can see at the top right corner here, the beginning of the 10 plus year age band, just as Bitcoin reached its 10-year anniversary, 2019. And these are essentially Bitcoin that have not moved in over 10 years. And it's interesting to see the trends over time, where especially as batches of newer Bitcoin come into play and how they're behaving. Are people holding on or hodling, or are people selling it during different times of the market? And different age bands kind of behave in different ways. We've seen that in different market conditions, different age bands behave in different ways. And just looking at Bitcoin transactions and UTXOs alone, we can also go one level deeper and actually looking at the number of UTXOs in each age band. This is an interesting metric because as wallets have evolved, they're kind of batching software to put the number of UTXOs in a given transactions have changed. And this is an interesting one where we've seen two distinct spikes throughout the history of Bitcoin, where the number of UTXOs, of new UTXOs has spiked. So that's these are just general longer term trends to keep track of, especially when there's a macro shift in the economy. For example, when we see a huge spike in new UTXOs, we know that a lot of the new Bitcoin that has been minted or has been moved very recently is continuing to move, and that's a signal as to how between two different types of users. A is the kind of quote unquote OG original buyers of Bitcoin who have been holding on for years on end. If they actually move the Bitcoin, it's a sign for the general market that they're trying to realize gains or transfer into another asset, for example. One of the other huge metrics, of course, has been tracking stablecoins, specifically tracking stablecoin supplies. This is another longer-term macro metric that we've seen in regards specifically to Tether, the most used crypto today. Tether is now primarily on the Omni protocol and on as an ERC20 token on Ethereum. It's also on Tron, but here's a chart looking at Tether supply over time. And what we've really seen are moments when Tether has been minted. So particular periods when Tether has been minted have typically shown a relationship to Bitcoin price volatility, one way or another. And most recently, the ERC20 side of Tether has really been taking over. Just over the past 24 hours, for example, there was over $1 billion worth of ERC20 Tether transacted on chain in terms of overall transaction volumes on chain. And so there's significant economic value to be gained in just looking at Tether movements. Firstly, because it's a unit of account for traders to realize gains or realize losses. And it's really the kind of the baseline crypto where you don't want to go into fiat as a trader. You're looking to transfer your crypto gains to Tether. And so when more Tether comes into play in the economy, there's essentially chances for more traders to realize gains and losses. And so there's more movement of crypto overall and more movement in the markets. That's what we've seen over time. One level deeper than Tether and then ERC20 token transfers is looking at function calls and events for smart contracts. This is specific to Ethereum. And so, looking at the DeFi ecosystem, we took a brief look earlier this year where one of the most popular dApps today is Compound, where you can lend and borrow DAI. And looking at ordering the wallets who had supplied and borrowed DAI from Compound, we saw who was the top DAI supplier and who was the top DAI borrower over time, all time. And the top borrower, in fact, is 6 times larger than the next highest borrower. So very interesting to look at who was the top borrower, especially. The top supplier turned out to be, a stablecoin smart contract that probably was one of the seed funders of Compound. And then the top borrower, in fact, looks to be an active market participant. He or she or they have several million locked up in a CDP on Maker, and also regularly deposit chunks of DAI into the DEX DYDX. And we see this behavior happening on chain, and it's another kind of macro type of strategy, trend following strategy, essentially, where we can just track this wallet, this address, and see how he, she, or they behave, and try to follow some of their patterns, some of their trading behavior to see whether they're profitable or not. This has been attempted by a few other players in the space before, but it's a tricky art because this one wallet may not be the only wallet that this user uses, and oftentimes, if they're sophisticated enough, they go through mixers or other forms of obfuscation to hide their trace when they're really making profitable moves on chain. So yeah, that was a little bit of a look at slow data, or thinking fast and slow, kind of the more longer term fundamentals. Some of the stuff we've been working on recently is the more faster data. So data that's more geared towards quantitative trading and acting really quickly on events that happen on the blockchain. And so the primary focus has been for us has been around the flows into and out of exchanges. And the way we kind of thought about this was, it was just kind of logic, where we realized that any trader, whoever they were, had to deposit crypto into an exchange first in order to trade. And the deposit usually went to an exchange deposit wallet. And one of the biggest things is each exchange, for risk and compliance purposes, has to wait before actually allowing a user after they have deposited to trade. And there's this lag between depositing and being able to trade, all the way from 1 confirmation, which is on Huobi and OKX, to 6 confirmations on Coinbase Pro, which is about an hour. In fact, this is a variable time, because in recent weeks we've seen blocks that have been separated by over 2 hours. So 1 confirmation could mean 2 hours later, after which you get to use your deposit to actually trade in an exchange. So it's a varying number, and so on average it's about 10 to 20 minutes, but there's still a significant lag if you're operating at the scale of a bot or a high frequency trader to actually execute on this information before it actually hits the market and impacts the order book, hits the order book. And so that's where we kind of got into the concept of tracking inflows and outflows into exchanges. So the thesis was, as soon as an inflow occurs, you can see that on the blockchain, and essentially you have a latency advantage over anyone else, as you can see the inflow before it hits the order book and essentially anticipate market movements before they occur. Similarly speaking, when you see outflows, you essentially are witnessing, especially outflows outside of an exchange altogether, outside of any exchange altogether, you're witnessing the kind of flow of funds outside the pool of funds available to trade in an exchange. And so you have a way of kind of estimating the size of the market, or how much a given asset can move based on the kind of funds held in an exchange cluster. So each exchange has several thousand to several million wallets typically. And what we do is we track the balance of this entire exchange cluster. So Binance, for example, has several million wallets. We track the balance of Bitcoin held in all of Binance wallets. And when that decreases significantly, then you know that there's been a significant amount of outflows, and the overall size of the market has essentially decreased. So internally, we kind of identify 4 different types of exchange wallets. So first off come the client-facing wallets. These are the ones that you typically see in the GUI when you deposit crypto into an exchange. This is what the user interacts with. And then typically, internally, exchanges use several different router wallets, which are effectively routing funds from different users to make up for internal liquidity. And then these eventually get funneled to either a cold storage wallet or to a hot wallet. And the hot wallets are the primary centers of exchange activity, where they send crypto typically back to the client wallets for withdrawals. And they often receive and send transactions with very, very high frequency. And these are the wallets that effectively provide liquidity for the users of the exchange. And so, a typical example of an exchange's internal transaction flow that we've seen is, where a user deposits crypto into an exchange, a client-facing wallet, and then that particular exchange has a specific behavior where it routes funds in a certain way, and eventually it typically ends up at a hot wallet, and that hot wallet is then used as the point of sale for crypto users or exchange users to withdraw their funds from. And so these hot wallets are kind of centers of hotbeds of economic activity. But if we really wanted to gain the latency advantage, we realized that we would have to start tracking not just the hot wallets, but the client-facing wallets and the routers as well. Because what often happens is sometimes a user deposits, say, 10 ETH into a client-facing wallet. That 10 ETH just sits there and then is maybe picked up a day later by a router wallet to then get funneled into a hot wallet, depending on the exchange's internal liquidity provisioning mechanism. So, but regardless, that user can still trade via the GUI on the exchange after 1 or 2 confirmations. And so those funds are still in the exchange cluster of wallets, and so it's still available to be traded. And so we really needed to map out every single wallet for each of the exchanges that we tracked. And one of the interesting things that we could do with this is essentially track minuscule hop to hop kind of transactions on the blockchain. So there was a large $1 billion worth of BTC transaction that happened a few weeks ago, and we were able to trace it all the way back to Huobi wallets, Huobi labeled wallets in our database. And so it's just one example of a fun thing that we could do. We did a similar thing for Binance. We did a similar thing for BitMEX as well. But apart from just doing fancy graphs for tracing exchange flows, some actual trends that you can follow to take advantage of this data is especially looking at inflows. So that's where our initial thesis came from for looking at exchange flows altogether. And so this is a look at ETH inflows versus price volatility. And so, the fundamental hypothesis is that the larger the inflows, the more the price is going to be volatile. And this is kind of proven true, as you can see in this chart. The blue is the ETH price volatility, and the red is the average amount of inflow going into an exchange, into the exchanges that we support. And you can see that essentially it's a very similar looking graph for both of these. When you look not just in terms of volatility, but in terms of just the raw price itself, it shows an even clearer picture where you can see the red line often precedes movements of significant movements of price, where you can see it here, you can see it here, and several other examples down the line as well if you zoom in. And so it's a pretty handy rule of thumb to keep in mind, where whenever you see large inflows, you typically know that the price is going to move in one way or another. And the prototypical example is where a large inflow typically means that a user is depositing crypto into an exchange to sell. And while it's hard to trace directly from a wallet all the way to a trade that executes on an order book, what we can see is exactly the time when the inflow occurred and the time when the price starts moving. And so obviously large sell orders are cause the price to move down rapidly, and you can see that in certain examples in this chart. While large orders are one factor of this, more sophisticated traders and or smaller kind of retail traders who follow the action is also another factor. So we looked at the number of inflows and compared that with price. Is actually also a very interesting metric where, especially with retail traders who follow price trends, it's interesting to see correlate the number of inflows to whether the price continues to move up or not. So as soon as the price starts ticking up, if we see the number of inflows start to increase in a scenario like this, you typically see the price move up even further. Similarly, you can see a kind of negative relationship coming along over here, where it depends again on the trading volume on the exchange. So A, you could have users selling ETH directly, or B, you could have users coming into and out of ETH, coming into and out of positions to maximize on price movement. So it depends on different exchanges and different time periods for the type of behavior that we see. But oftentimes, regardless of whether it's up or down, we typically see a movement in price when the average amount of inflow increases and the number of inflows going into exchanges increases. Another big metric that we've been working on more recently is the flows of miners from miner wallets to exchange wallets. So, mining in general in this ecosystem is a kind of constant economic rhythm that essentially is stable throughout the course of a blockchain, where especially proof of work miners need to sustain themselves in the real world and thus need to liquidate portions of their block rewards to sustain themselves. And so it's a constant sell pressure from miners that has to happen in order for them to sustain themselves. And what's interesting to note in this chart is when miners hold on to their funds after they've earned them in block rewards and then sell them at opportune times when the price is moving up or when the price is moving down. As you can see here, BTC.top is a large mining pool. They had been mining all throughout 2016 and took a lot of their profits, and the price started spiking up in mid to late 2017. And similarly speaking, you see BitClub Network selling a lot of their BTC, of their earned BTC, as the price was spiking down, driving it even further down. Obviously to make sure that they don't suffer any more losses, and they made a good move. As you can see, obviously they timed the market to a certain extent. And so when miners do make extraordinary moves, of course there's a constant sell pressure from miners, but when miners do make extraordinary moves, it is something to take note of, because essentially they're the ones who kind of set the pace in terms of sell pressure on the market, and when they increase that pace, there's a kind of macro impact on the entire economy. It's a domino effect. And when you take this to the nth degree of fast data, you get to our latest kind of project, which is predicting future transactions by looking at the mempool. So we run nodes all over the world, and from these nodes, essentially you are collecting data on the transaction mempool, which is transactions that are broadcasted from wallets worldwide that pay a certain amount of fees to have their transactions included in the next block or the next few blocks. And the mempool is essentially a store of transactions that are about to be included in the next few blocks. And so one of the things that you can do is look at the fees paid and use a specific fee model to estimate when this particular transaction, or which block this particular transaction is going to be included in, and kind of where it's going to be included. And so, I mean, this is a look at the mempool over the past 48 hours, and the number of transactions in the Bitcoin mempool over the past 48 hours. And you can see that it spikes at certain times and goes down at certain times. And especially over the past few weeks, as we've seen odd block timings where some blocks were 2 hours apart, the mempool really built up in terms of the amount of transactions that needed to be included in the next block or so, because as more and more people were more people were trying to withdraw from exchanges, those withdrawals didn't go through for 2 hours because the block timings were that far apart. And so a lot of those transactions are broadcast on the mempool, and unless they pay the broadcaster of the transaction paid enough fees to include it in the next block over the next person, it wasn't included, right? And so you had a further lag as kind of the queue of the mempool needed to be cleared. And so this is really to the nth degree, where if you're really executing at an intraday, intra-hour, intra-minute level, where you can really utilize mempool data and predictive consensus, predicting when a transaction is going to be included in a block to execute trades. So how do we integrate this kind of into your workflow? We have a WebSocket currently where you can subscribe to either zero confirmation transactions or mempool transactions on Bitcoin, and not just transactions, but contextualized transactions, which show exchange flows. So every inflow, outflow, intra-exchange flow or inter-exchange flow, and the probability of it being included in a specific block. So all the blocks that you see here are actually blocks that are in the future at the time that I ran this. And then concurrently, you can then execute orders using a bot based on when a particular transaction is going to hit an exchange. So some of the factors or metrics that we went over earlier, you can integrate those metrics into a trading strategy that can execute based on, for example, a large inflow, or based on a series of consecutive inflows going into a specific exchange. And you have essentially, if you have a latency advantage following the strategy, because you're seeing the transaction that's about to hit not only the blockchain, but then further on will hit the order book into an exchange. Going one step slower, you can of course back test and historically look at some of this data to see trends. One thing to note that we've seen internally is that patterns switch up over time. It's not always a straight and narrow pattern that's followed throughout the history of the blockchain, especially towards the huge price spike, 2017, 2018, where a lot of the quote unquote strategies were skewed because the price just kept going up regardless of what happened. And so oftentimes what's a more reasonable time frame is something more recent. So something around this year, 2019, has been slightly more stable in terms of seeing recurrent patterns and testing them out and testing out strategies. And we have all of this data, all of this historical data available via API, via CSVs. You can plug it into your notebook and start integrating it today into any trading strategy or that you want to backtest or implement. And then finally, we also have a web platform at TokenAnalyst.io. Some of you might have seen it already, where we've essentially have trading view charts along with every metric that we've covered here and many more as well, that you can just plug in and compare each metric to each other and see trends that are happening in the market. And essentially do a version of on-chain TA, on-chain technical analysis, where you match the flows, you match on-chain transaction volumes, active addresses, token supplies to how the markets are moving and how on-exchange volumes are also impacted through that. So, I mean, that's kind of a brief tour through, the universe of metrics that we have available on the blockchain. It's obviously hard to go into depth on any specific one, but there's a whole universe out there just waiting to be explored, and just wanted to share some of the things that we've seen that separate some of the signal from the noise. So yeah, thanks a lot for attending. Open to any questions that any of you may have. Please do post in the chat, and I'll take a few minutes now to answer them. All right, I see a few people asking for OTC tracking. So yeah, I mean, we're working on that. We've been working on that. So Just for some context, the way we label exchanges is a pretty comprehensive process, which is effectively where we have scripts that run every single day to transact with exchanges, to deposit and withdraw from exchanges, and then track their transactional patterns on chain to see how these exchanges behave internally. And so typically this is just going through the normal, GUI transactional process. And OTC desks follow a different process where sometimes we've seen they often deposit directly into hot wallets. And so where we can see OTC desks come into play, and we've been seeing recently, especially in regards to Kraken and some of the other exchanges, where uh, the inflows into the exchange don't directly follow the inflow procedure from a typical client deposit wallet, but they come in directly into a hot wallet. And so some of those inflows where we've been tagging as OTCs and seeing if they repeat over time. So hopefully we should have some metrics on OTC desks over time. So yeah, will more exchange wallets be tracked in the future? Did you find some exchange wallets that were untraceable? Yeah, I mean, we're constantly looking to add more exchanges to our, offering. It's just about making sure that we're confident in the data. Obviously, the patterns that we see on chain have to repeat over time in order for us to add them to the platform. But some of the exchanges are hard. We'll admit it. Coinbase is a tough nut to crack. Because they specifically, from what we see on chain, they move the funds, they change up their transactional patterns almost every day, and so we're trying to crack that. But definitely coming up the pipe, we have a few of the derivative exchanges, Deribit, Bybit, FTX should be added to the platform. Yeah, is TokenAnalyst working on machine learning trading systems with our data? Currently, we're not. We've been so focused on building this data pipeline that's to make it as efficient as possible, as fast as possible. But we have been using machine learning techniques internally to classify and cluster these wallets. Our team has several PhDs who specialize in this, and we use machine learning for effectively labeling these wallets to better gain context into what type of entity a given wallet is, whether it's a miner wallet, whether it's a OTC desk, an exchange, a bot, a human being, so on and so forth. Have you ever considered adding a feature that allows you to track addresses and set up alerts whenever a transaction is initiated? 100%. In fact, we're working on something similar right now that subscribes to our WebSockets where you can filter, uh, not just for addresses, but filter for large transactions, filter for inflows, filter for outflows, and effectively you can have your custom filter for events happening on chain. So, and hopefully that's delivered not just through WebSocket, but also through Telegram, Slack, and some other channels. So yeah, so when there's an inflow to an exchange, does price go down usually? It's a tricky one to because it's kind of depends on the exchange. So for example, spot markets are different than derivative markets. BitMEX is a bit different, where there's kind of different domino effects, and also at different market conditions, where sometimes inflows don't. So effectively, it depends on how long a user holds their funds inside an exchange before actually executing trades and hitting the order book. And so that depends based on the market conditions and based on the type of instrument being traded. Hmm. Is it possible to detect DEX activity? Yes, it definitely is. We see makers and takers and the function calls made by DEX order books on our database all the time. And not just with that, but also with the mempool, with front running DEX orders. There's been research published on this as well. We haven't personally gone as deep yet because of the volumes on DEXs are not that big compared to centralized exchanges currently, but it's definitely an area of opportunity where you can subscribe to smart contract to the DEX smart contracts and get the entire DEX order books to then create trading strategies that execute faster on chain than others. It would be cool to see an integration with Hummingbot or something like this. Any plans to add something? So we actually have a an open GitHub repo with sample code to effectively integrate our WebSockets into your workflow. It's in Python. So I think we can share that link here. But additionally, we're also working on some sample code for a simple trading bot to trade on exchange flow data directly from our WebSocket. So that'll also be in Python. And we're hoping to get that open sourced in the next couple of weeks. And yeah, I'm sure an integration with Hummingbot, there's a couple other really nice services out there where we can integrate our data and it will be really useful for people. Is Binance easily trackable? Well, it's yeah. I mean, again, it depends on the exchange. Binance outflows generally follow from their hot wallet, which is you guys can probably find on the blockchain. But inflows are a different story. Especially for the low latency, the customer client deposit wallets. You have to really run some sophisticated algorithms to find all the inflow wallets. So it's tougher than that. All right, so I think that's a good amount of questions. Happy to answer any more. Feel free to get in touch via our website, via intercom, or directly to my email, sid@tokenanalyst.io, or DM us on Twitter. We're constantly looking for feedback on what we're building and also on different metrics that people like you want to see, different exchanges, different assets, what we should be adding next and what we should be building next. And so our goal is to help out traders and investors and participants in this ecosystem to better understand the blockchain. So thanks a lot. Thanks for coming. Hope you have a good rest of the day.